All right. Good morning, good afternoon, good evening again. This is Fabrice from SAFA. Welcome to our second webinar on the January one after our first one just before the Christmas break. We are delighted to welcome you on board our journey on exploring sustainable aviation fuel in Asia. So the theme for today is to deal a bit of looking backward at what happened in 2024 and also survey an outlook of what we'll see for 2025. We will start with two of our guests today, two of our members. Our first member is Harry Riley. He's from Quantum Commodity Intelligence. Is a commodity journalist and editor. He's been in the field for more than 15 years, and he will introduce us his company and what they are doing at the moment, what Quantum Commodity Intelligence is doing. And our second guest is Daisy, and Daisy has been working for SkyNRG. She has a background as a chemical engineer from Delft University of Technology. And she's been also engineering doctorate in process and equipment design, and she's joined SkyNRG in 2023. So she will introduce us the market outlook produced by SkyNRG last year. So without further ado, we will finish also with Gabriel and I with a bit of forward-looking into the challenges and opportunity of SAF in Asia from 2025 at the end of the two presentations. So without further ado, I propose to start with Harry. Harry, the floor is yours.
Great, thank you, Fabrice. So I'm going to share my screen now, and hopefully this will be golden. Let me just play it. How's that look to everybody? Look okay?
Look great.
Great. Okay, so hello everyone. My name is Harry Riley Gould. I'm the managing editor of the biofuels desk here in London for Quantum Commodity Intelligence. So just to give a little bit of information about us for those who don't know, because we're a relatively new company, Quantum was established in 2021 with the intention of widening access to critical price benchmarks in the energy transition space. We currently offer services across oil, biofuels, ammonia, hydrogen, and carbon, and are rapidly expanding as well, having nearly doubled our employee count in the past year. We're primarily based in London, but we do have an established office in Singapore, and we also recently opened a new office in Houston, Texas, in order to expand our offering into the US market. So within the biofuels desk on which I sit, we're covering biodiesel, ethanol, biofuel certificate markets, and of course, renewable diesel and sustainable aviation fuel. So today, really, I'm just going to give a broad overview of the state of play in the SAF market at the beginning of 2025, and look at how the market and prices developed in the past year, and an overview into where the market could be heading moving into 2025. I would say in general, the key points are that SAF in general, certainly on the spot market, was very depressed last year. There was a lot of pressure and limited underlying real barge demand in Europe, I'm talking. Meanwhile, in major projects by oil majors were paused. There was slow output from existing and startup plants as well. In the US, as I'm sure everyone's well aware, the market's highly uncertain due to the election of Trump, and how the new administration will approach the biofuel market remains relatively unclear. And finally, feedstocks remain a key bottleneck throughout the global system, particularly in light of recent moves in Asia to retain feedstock domestically in order to promote domestic production, which could threaten producers elsewhere, such as in Europe. So moving on to SAF pricing over the past year, I want to clarify here that the price we're looking at is reflective of the spot ARA barge market for red compliant HEFA SAF, loading 7 to 28 days forward, not term deals or alternatively produced fuels such as ethanol to jet or anything like that. So this price is also a premium over ICE gas oil futures. It's currently the only SAF market we assess is the ARA FOB price, but we do have plans to expand our offering for SAF into the Asian market and also the US in the relatively near future. Looking at Europe, the main story really for prices in 2024, as I mentioned, was stagnation, I would say. You can see there certainly in the first half of the year, prices steadily declined and then were relatively flat in the second part of the year. The premium opening in 2024 around $1,500 per cubic meter over gas oil futures, but by the end of May that was below 800 cubic meters, and then subsequently bounced around a rough sort of $800 to $1,100 per cubic meter range over the rest of the year. Now, what drove that slowdown? I think there's a few things going on here really. So one obvious point is that SAF capacity globally has been coming online this year, ahead of the introduction of mandates in Europe and the UK in particular. And that's created a lot of spot pressure over the past 6 months of the year, because these plants have been coming online. They want to get first mover advantage in order to get ahead of the market, but at the same time, ahead of the mandate introduction, underlying demand for SAF has generally been pretty weak. With the absence of mandate demand, it's the market's basically been reliant on voluntary demand, and that didn't really come through, I think, in the way that the people were expecting. We were frequently hearing throughout 2024, certainly in the early part of the year and in the summer, that while the market was slow, there was a general expectation that things would pick up ahead of the introduction of the mandates in Q4. But in the event of it, that narrative didn't really come to pass, as it were. And again, the question is, why is that? I think the reality is, as in all markets, most of the volumes have been bought and sold on term contracts, certainly for mandate demand, which has left a relatively small portion of the market for the spot market. And this is particularly true, of course, for SAF, when there's various different production pathways and variable sustainability criteria. So it can have a big impact on what you're buying and the value of the underlying fuel. So taking that into account, on top of which, the mandates are only kicking in at a 2% blend, which is still relatively low. It just doesn't really leave a huge portion of demand left in the voluntary market, which is what barges, from what we understand, is mainly reflecting so far. And it's also worth noting as well that even in the renewable diesel market, that there has been some slowdown as well. So while it's been a slowdown on SAF, there's also been a broader slowdown in renewable diesel, HEFA, also produced during the HEFA process, of course, but also biodiesel, which has weighed on the tickets markets as well, which I'll talk about that in a minute, but that's also had an impact on where we see this premium over gas oil moving. Now, in terms of the liquidity, there's a question, is that going to pick up in the next few years? Certainly, it's possible that as the mandates begin to tighten and the market becomes more liquid, then that could follow through into the spot barge market. But even then, it's also worth considering that in the renewable diesel market, which, as I said, is very structurally similar to SAF in Europe due to the similar production pathway and fuel spec and so on, liquidity on the spot barge market remains relatively low, even though that market's been active for many, many years and has much longer standing mandates than in the SAF market. So that's not to say that it won't pick up, but equally, it's going to depend on how the market absorbs these increase in their mandated volumes in the years and how the logistics of that end up working out. So moving on a bit, I'm going to look briefly at the situation with the tickets markets as well, which, as I mentioned, did have a big impact on SAF this year, certainly in the fourth quarter. So if you see that there was something of a pickup around October, November, in terms of the premium over gas oil and also over jet. So I'm just to be clear, I'm switching units a bit here. So this is a SAF premium to jet fuel, spot barge over CIF Northwest Europe jet cargo, and that's measured in dollar per ton. You can see it's basically a similar trajectory to the premium over gas oil. But if we introduce this, which is the price once you've taken out the the value of renewable certificate rebates, then it's a bit of a different picture here. So this green line here, again, a very simple calculation. This is just taking the SAF premium over jet cars on an outright basis and then stripping out the value of the rebate from the Dutch 9B certificates. And what you can see here is that from around August, the value of SAF actually dropped to around zero, over jet once factoring in these rebates, which is, I think, what we'd probably expect to see given the relatively slack demand that we were seeing on the spot barge market. It kind of makes sense that there would be some convergence between the fossil and the SAF price, because ultimately these two prices are in competition to some extent. Now, what you might have noticed is that green line drops to an extremely steep discount in November. And just to explain that very quickly, I'm going to have to veer away briefly from the SAF market, because that's really due to a huge spike that we saw on tickets. So just to look at the renewable diesel market prices, HVO, the UK barge price, or premium, sorry, which is again meters cubed, and the Dutch HB9B ticket price, you can see a lot of synchronicity there. Essentially what happened was there was a big moment of market tightness around November. So Neste Rotterdam, which is Europe's largest biofuel biorefinery, had a fire, unexpected fire, which prompted a plant shutdown. On top of that, we also had a number of other plants out at that time for planned maintenance, such as Eni's plants, and there was also the delay of a startup for a renewable diesel unit at Prim. Now, because Neste was basically unable to supply due to the shutdown of their plant, that meant that a lot of obligated suppliers on the road fuel market had to go into the tickets market to cover their obligation at the end of the year, which led to a massive spike on the tickets. That then also led to a spike on the renewable diesel. And then once that volume had been covered by fuel suppliers, it just dropped off the floor again. And we saw the same thing happening on the renewable diesel. Now, I think one of the interesting questions during that period is, why didn't we see the same move on SAF? Why was the impact so muted? You did see, as you can see, over November, December, there was some upward movement, probably about $200 per cubic meter on the premium, but relative to the value of the certificates that we saw during that week or 2 week period, it was really very minor, unlike in the renewable diesel market. And I think there as well, why that is really just returning back to this issue of liquidity and a relative lack of liquidity and real underlying demand for barges, which meant that the market simply wasn't there to react as quickly and as rapidly as we did see on the renewable diesel market. And one point I would stress as well is that while I'm talking a lot about the spot market, because that's the market we price, we do get information on term deals as well, which we publish in the report. And we do understand that whereas the spot liquidity has been very low, term deals, particularly in Q4, were being done. That market has been bubbling along relatively steadily, which is probably what you would expect given that the introduction of the mandate. And critically, the prices that are being done, frequently we were hearing are being done well above what we're seeing in the spot barge market in terms of the price level, and frequently are not being really structured around these spot prices at all. In fact, most deals, from what we understand, are typically being struck at an agreed premium to the fossil jet price. So that's the basic trajectory on pricing that we saw last year. So moving on to the next segment, I'm just going to talk about the impact that we've seen in the market in the past year from that price slump and general weak prices. One of the larger stories of the summer was certainly that we saw oil majors pulling back from major investments into the sector in Europe, and I'll clarify that in Europe. So BP cancelled projects for standalone SAF units in Germany at the Lingen refinery and also at Cherry Point in the US. Shell also paused construction on its Rotterdam HVO SAF plant, which would have been the largest on the region, and took a $2 billion write-down on that shutdown. The current state of that plant remains a bit unclear. They've just said that work is paused, which means it could theoretically restart at some point. But there's been a lot of comments from the Shell CEO suggesting that that it's not really a market that they want to be getting into at the moment, certainly not in Europe. Now, while the majors have been pulling back on these plans in Europe, that's not necessarily the case elsewhere. So, for example, BP did make investments into Asian SAF capacity in the past year. Eni also has a project in the works in Asia, which I'll talk about a bit later. So while the pricing slump has led to something of a pullback from the oil majors, it's mainly been concentrated in European assets, which does make sense. I mean, to some extent. So if you're listening to the investor calls, the CEOs of both BP and Shell said basically that they see overcapacity in the midstream segment on biofuels, and instead have been diverting capital to the upstream segment. So both Shell and BP made investments into feedstocks markets this year, where they said they see the most high opportunities to capture a high margin. So Shell invested into new capacity at its Brazilian ethanol subsidiary, which is Raízen, which is a joint venture with Cosan. And also BP took full control of what previously had been BP Bunge Energia, which was also in Brazil, and had been a joint venture with Bunge. So that's, yeah. So from the oil majors, that's what we've been seeing, really, a rediversion of capital away from the midstream segment into the upstream bio segment in terms of feedstocks, at least in Europe, but also ongoing investments elsewhere. Two other firms, another firm I didn't mention earlier, but also Total Energies, we've seen investing in Asian SAF projects this year. So that's the oil majors. What about some of these more independent existing producers? So those with a big exposure to bio, certainly in Europe, suffered a lot this year. Just to touch on what we've been seeing in Neste for a second, as I'm sure many of you know, they've had a bit of a tough year, had to basically restructure their entire board, new CEO, share prices coming under severe pressure. And that was because they had to make several downgrades to their renewable product sales guidance, as well as their margin outlook several times over the year, due to the weakness that they were seeing in the renewable products. So Neste's renewable product sales guidance for SAF specifically, by the end of the year, was around 350 to 550,000 tons. At the beginning of the year, they were estimating between 500,000 and 1 million tons, and that was their outlook for SAF sales. So nearly a 50% decrease in terms of their expected guidance in the SAF market. For the larger renewable fuels market, the revision down was from 4.4 million to 3.7 million. So again, you can see the weakness across all sides of the market, certainly on the bio space for them. Again, their margin as well had been initially pegged at $600 to $800, and then was revised down to $360 to $480 per ton by the end of the year. So around 40% increase, which I think gives some indication of the pressures that we've been seeing in the wider market. And this is not just a European story as well. So in the US as well, we've seen margin stress from some of the renewable diesel producers, a number of whom have been building out SAF capacity, such as Darling Ingredients and their joint venture with Valero, Diamond Green Diesel. They were frequently saying that prices were really under pressure there in the US market. And again, that's because we've seen a big rush of capacity coming online, pressure on certificate market, which has then fed through to lower fuel prices, essentially. Just to turn to the US now quickly, I think we did see, as I mentioned, some new major plants coming online due to the Inflation Reduction Act subsidies. So the largest of those this year was Phillips 66 Rodeo plant. I've got the capacity here in gallons, but just to clarify, this is the overall fuel capacity, so HVO and SAF, not just SAF. Phillips 66's Rodeo plant came online. The DGD, Diamond Green Diesel plant I just mentioned, and also LanzaJet's Freedom Pines site in Georgia, which they bill as the world's first commercial scale ethanol to jet plant. What's striking really about these startups is that actual production volumes have remained relatively constrained. So the EIA over the summer said that they expected that US SAF production could hit 30,000 barrels per day by the end of 2024. Which is around 38 million gallons per month. RIN data for November, however, indicated US domestic SAF production around 2.4 million gallons. Now, there are some good reasons for this. So DGD's Port Arthur facility only really started up at the very end of the year, so there's no way that they were going to be able to ramp up capacity, full capacity by December. In the case of the Rodeo refinery as well, PC66 actually said that they were switching to renewable diesel production and using up high carbon intensity feedstocks ahead of the switch to 45Z producer credit in January. So they weren't really producing much SAF either. But even then, I think the extent of the underproduction is somewhat striking, especially given that RIN data would, also reflect co-processing at other plants. And if the margin environment had been stronger, it's possible that you wouldn't have seen the production pullback from quite the same way. In the US market, there's a lot of questions really, I think, going into next year, as I mentioned at the start of this presentation, revolving around how the new administration is going to approach the biofuel market. So on SAF, on this 45Z clean fuel production credit, there was some preliminary guidance issued by the Biden administration last week, but that's very preliminary, and ultimately the new administration under Trump could rip it up or take a totally different approach. It really rests with how they want to handle things. Trump himself has a pretty long history, I think it's fair to say, of opposing renewable energy schemes. And he's also appointed a relative climate skeptic in Lee Zeldin to run the Environmental Protection Agency, which runs the RIN program. So, on the other hand, there are also a lot of reliably Republican states in the Midwest with large agricultural lobbies who want to sell their crop feedstocks to new biofuel plants, particularly in light of a potential slowdown if electrification continues to weigh on gasoline demand in the US. So they might be pushing to maintain more aspects of that program. And it's also that some of the conventional refiners also have a bit more skin in the game at this point. Someone like P66, for example, they have their own plants now and have more invested in this space. So it may be that they push to retain some of the more pro-bio aspects of the Biden program. Exactly how that's all going to play out really remains very uncertain, and I think we're just going to have to sort of wait to see how things progress as the year moves on. There are some areas where they could make changes. One would be increased tariffs on Chinese feedstock supplies into the US. Trump, as we know, has made tariffs a kind of core plank of his platform, and there's been a lot of chat recently about whether the planned tariff increases will really come through, whether they'll be turned down, whether they'll be targeted. Again, it's all a bit unclear. There's been a lot of complaints in the US from politicians about imported feedstocks from China, particularly from some of these Midwestern politicians with large ag constituencies. And they don't want fuel made from imported feedstock to be eligible for the 45Z credit. Now, under the guidance that was issued by Biden last week, they banned imported UCO to make renewable diesel, which wouldn't be eligible for the credit under the guidance. But under the SAF specific guidance, they said that to prove carbon intensity scores, you can either use the GREET model, which would mean no imported feedstock, or CORSIA, which could potentially open a path for imported UCO feedstock to be used to produce SAF specifically. But again, whether they make a decision on that is a little bit unclear. Another area where they might be looking at changing things is and have a bit of latitude to make changes is to set the ease the GHG requirements for biofuel feedstocks, potentially ease some of the indirect land use carbon intensity requirements for corn ethanol, for example, could be another path they may go down. On the demand side, I think there is some risk, given that the US doesn't have federally mandated volumes. There are state programs that do incentivize renewable fuel uptake in certain states. For example, Illinois is relatively generous, but we have seen in the past few weeks and months a lot of large US firms pulling back on some climate commitments, and so ahead of the new administration, and so that could be a concern for people trying to sell SAF into the US. Now, just to continue talking about feedstocks a bit, As I'm sure many of you are aware, this is a key bottleneck for HEFA plants, both in development and operating. So as you can see here, US and EU imports of used cooking oil remain heavily dependent on inflows from Asia and China in particular. This is just UCO. Obviously, there's other feedstocks such as POMI, for example, which are effectively only sourced from Asia. Now, this is a long-running issue, as we know, but I think what's been changing lately is that Asian governments have really been stepping up and looking much closer at how they can retain this feedstock domestically in order to support their own biofuel blending and production programs. So even in the last few months, there's been some quite big changes in the market. So China in November scrapped a 13% export tax on used cooking oil, which, you know, could be possibly seen in some parts of the market as a first step in maybe developing some more demand side policies on SAF. They've also got, you know, a number of HEFA SAF plants under development, and by diverting product over to SAF production over renewable diesel, that they can therefore circumvent some of the EU anti-dumping measures that came in the summer. You know, I mentioned earlier as well that Western firms are getting into this space. So BP invested in Chinese SAF capacity. Total is active in China as well. Also, only this month as well, Indonesia announced it was tightening its export approval applications for used cooking oil exports, and also tightening rules on POMI, which again was intended to ensure it had adequate biofuel feedstock inventory levels ahead of a switch to B40 biodiesel on the roadside in the coming months. And there have also been accusations of virgin palm oil being mislabeled as waste feedstock or blended into waste oil and sold into Europe, which they're trying to clamp down on as well. And also they have their own projects, SAF projects in Indonesia as well. I'm going to look at some of the Asian projects coming up in a moment, but the general trend, at least in the last 6 months, and certainly we expect to see that continue, is moved by Asian governments to retain this feedstock more domestically in order to support their own production programs, and that does create something of a question for some of these European and US to a certain extent projects that are coming in, particularly as well. You know, if we're moving from a more free trading environment globally to a more protectionist environment, which tends to be the way that people see the election of Donald Trump and the way that global policy might be going. You know, what does that mean for biofuel plants and projects which are very heavily dependent on these international feedstock supply chains? It could be a real headache for some people. So I'm going to move now on to the Asia market. Yeah, as I've just said, you know, much as elsewhere in the world, we're expecting to see a lot of Asian capacity come online over the next few years. This, you can see here just a small sample of projects that are under construction or have come online, including, you know, Neste Singapore expansion, Jiao and Protex unit, which came on, I think, at the end of last year. Cosmo Oil in Japan recently entered the commissioning phase, and they're also expected to come online in the next few months. We've got other large projects, as you can see, Thailand, China, Indonesia and Malaysia, and there's also numerous projects in development in Southeast Asia, India, Pakistan, and also the Middle East, and also moves to do more co-processing as well. I think it's safe to say that a lot of these new Asian plants are likely to be highly cost competitive certainly with European producers, given the cheaper access to energy, essentially, and also labor and input costs, and cheaper feedstock availability and so on. So something we'll probably be looking at quite closely over the next few years is how comfortable is Europe going to be taking imported SAF volumes from Asia? Will we see pressure to introduce trade defense mechanisms to support domestic production capacity, similarly to how we've seen trade defense measures imposed on biodiesel and renewable diesel in the past year in Europe? You know, I think it's very likely that we might see some calls to have SAF rolled into some of those other measures that we're seeing on renewable diesel in particular, for example. And in fact, we've already seen calls from some sectors. European producers, for example, Neste, who obviously has quite a large stake in this market, has said that SAF should be included in the anti-dumping measures. On the other hand, while that might be the approach of industry, the political situation in Europe is probably a bit more tense on the SAF side. Certainly, you know, with these mandates being introduced, there's a general acceptance that is going to lead to price rises. But in the context of high inflation over the past few years, is that political will going to remain there? If complaints really start stacking up, even in the UK, which introduced their SAF mandate, and this month in January, there was already a report out, I think last week or perhaps a week before, that ministers were looking at potentially rolling back the scheme if the impact on airfares became too high. For example, if it moves up to as much as 20% increase in fares, that they would repeal some aspects of the mandate. So it's a big question as to how those two dynamics will play out in terms of European producers wanting to protect their market, and also on the political side, regulators wanting the market to have access to the cheapest SAF available on the market, given the mandate, which is likely to come from Asia. Another factor as well worth considering on this front is how book and claim programs are going to develop over the next 5 years. That could make a big difference in terms of trade flows. It's particularly with the European mandate, because it could mean that there's no actual need for physical SAF volumes to move, which could potentially ease some of these price pressures and also change some of the nature of competition due to the difference in logistics requirements. However, again, this Asian capacity is not only coming online to target European demand or US demand for that matter. So, looking at some of the policies that are coming into place in Asia, we're seeing numerous targets or mandates being discussed and potentially to be introduced. These generally are varying in terms of their scope and their scale, but a number starting at 1% in 2027, which obviously would coincide with the beginning of the mandatory phase of CORSIA's offsetting scheme. Some of these are confirmed, some of these are planned, but I think it's likely that we are going to see demand rising, SAF demand in Asia rising substantially over the next sort of 3 to 5 years. And the one country where there remains a big question mark, of course, is China. What do the Chinese government want to do with SAF? And this is probably going to become increasingly important as SAF capacity picks up, out to 2030. So we saw a SAF developer in China. They recently said that they expected to see Chinese SAF supply exceeding demand by around 16 million tons in 2030. That's production pegged at around 19 million tons and demand at 3.1 million tons under current policies. So, what do the government want to do about that? Is the answer for them to introduce some kind of mandate? We have heard rumors that it's being considered by policymakers, but it seems likely that the market is not really ready to absorb that yet. But if plants, coming online, if there's a big oversupply of capacity, and Europe is also resisting attempts to sell that into Europe, if they're establishing trade barriers also into the US, then that could be one path that they go down, would be potentially the introduction of a mandate in China, which would be relatively huge for the market. But let's see. It's that's probably not one for 2025. That's probably something that we might be seeing a bit further out. So yeah, that's really most of what I wanted to talk about. I think the key questions for 2025, the way we see it at least, is number one, how will the market respond to higher capacity this year? New volumes coming online as the US, as I mentioned, in Europe, Neste's expanding at its Rotterdam site, Singapore, new projects in Asia that I just mentioned. Can the market rebalance under those circumstances? A big question is, where is voluntary demand going to be? I think we know pretty much where mandated demand, at least in Europe, is going to be. How is voluntary demand going to develop in the US, in Europe, and elsewhere, particularly in the light of political changes going on, in the US in particular. Secondly, speaking of that, what's the Trump effect going to be on the SAF market? How will the new administration approach the market? Will they just repeal the Inflation Reduction Act completely? It's not impossible. We don't know, really. And I think perhaps more interestingly is how corporate behavior will change under a less pro-climate leader, such as Trump. What does that mean for the voluntary demand sector in the US? Thirdly, I think, again, moving on from that is SAF trade wars, tariff barriers. How will SAF be viewed by policymakers? Is it something that they're going to be happy establishing a more global market if it means more pressure on domestic producers in Europe, for example? or will we see the erection of tariff barriers and concern about volumes coming in? Just a final slide, short plug for us. As I mentioned, we're Quantum Commodity Intelligence. This is our news and pricing platform on the biofuel service. I think I mentioned we cover SAF, but also biodiesel, HVO, ethanol, feedstocks, and certificates. And again, we also have other services which cover oil, ammonia, hydrogen, and carbon markets. So if anyone is interested, we do offer free 2-week trials. So please reach out to us or me. I think you should be able to have access to my email through this. So, we would be happy to get anyone interested set up in a trial if that's something that you'll be interested in. Thank you.
Yeah, thank you very much, Harry, and a very insightful presentation. I saw a lot of our favorite theme that you went into details on and bring also some highlights from the rest of the world, trade wars, and I think that, for example, rise of capacity from the US, and I think that's where it makes a lot of sense for you and us to cooperate and to gather the whole ecosystem in Asia, to have a common playground here in the region, so that we try to avoid all this unfair competition, biased sales, and hopefully all the industry will benefit from having a common playground globally, at least in Asia. So thank you very much. I'd like to ask the audience if they have any questions for you, Harry. I haven't seen any. Please feel free to raise your hand. Okay, that's coming. Cool, great. Thank you, guys. All right. Do you see the questions, Harry, or do you want me to read them?
Yeah, I can see that. So 45Z. Yeah, this is a bit this is a bit of a running question, I think, and I would probably, in terms of 45Z, I would probably just wait off, because this new guidance that's been issued by Biden, that's it's been waited on for a long time in the industry, but let's be honest, he's going to be out of office next week, so there's a very strong likelihood that the terms under which this credit is operating get changed anyway. But yeah, under the guidance that we saw, the credit said that you could either, for carbon intensity scores, you could either use as a proof, you could use the Greek model, which is the US developed model, which would mean that UCO and used cooking oil imported volumes would not be acceptable, because the argument is that it's impossible to really validate the carbon criteria of that, because of alleged fraud in the supply chain. That's what they say. But it does say you could also use the Corsia model as to prove your carbon intensity score. In which case, potentially that could open the path for fuels made with imported UCO to be eligible for the credit. Is our understanding. However, as I would say, I really would just give it a few weeks, because probably this is all going to change anyway. And I think certainly a lot of the US producers, which we've been seeing, holding off on production, as I mentioned, they've been holding off on SAF production partially because the rules of this new credit weren't that clear, and the truth is that they still aren't very clear. There's still a lot that hasn't been issued. So I think on that one, probably just need to wait and see. And I would certainly think that it's likely that UCO gets hit by some sort of tariff anyway. Donald Trump said over and over again that he wants to introduce some kind of blanket tariff on Chinese imports, so that could affect the flow regardless. What are my thoughts on the viability of small scale SAF HVO plants? That's hard for me to say, really. As with anything, it depends on where you are on the cost curve. I wouldn't want to just speculate randomly. A lot in terms of which plants are viable and which aren't is ultimately going to come down to feedstock access and the cost of that feedstock. But outside of that, it's hard to say purely on the size alone. It would depend, and depend on where you are. If you have access to a small airport, I suppose, where they need SAF being delivered and you can capture that market, then possibly. But again, I probably shouldn't speculate. What about SAF certificates bought by corporates to offset Scope 3 emissions? Yeah, so certainly that is a big part of the market that's going to be growing over the next year. And as I mentioned, with book and claim schemes, that will drive some incremental demand, certainly. I think the question is how in the US, certainly, how many of those targets, are kept. We've seen banks and, for example, abandoning a lot of climate commitments and so forth. Do we see a general move away from ESG and those kind of climate commitments that we've been seeing from firms in the past few years who have been keen to kind of get ahead of in some ways, get ahead of subsidies as well under IRA? If there's a move away from that, then it could be less relevant. But yeah, certainly that's one area that we're expecting to see growth this year.
All right. Thank you, Harry, for again sharing all those insights and all those detailed values from the past and expectation also for the. I think that you have a lot of information there. So for the audience, if you didn't follow, we can ask, of course, the participants for their agreements, but we are planning to share our webinar on the YouTube later on. So you will be able to access the presentations and the comments and the questions for you and also your colleagues or friends at a later stage. Thank you again, Harry.
Thank you very much.
All right, excellent presentation. First step of our webinar today. Daisy, are you ready to follow up from Harry? Hey, hello.
Yeah. Hi. Yeah, of course. Yeah. So today, I'll be talking about the SAF market outlook that SkyNRG we publish every year. So this will be based on our 2024 SAF market outlook. So today it's divided into two separate sections. The first one is at the 2030 market outlook, and then we'll touch also briefly on the 2050 market outlook as well. I think to begin, I always like to show this slide just to get everybody on the same page of why SAF is important to us. Yeah, the global aviation emissions contribute approximately 3% to the global emissions. And with the current trajectory that we're growing, the emissions are bound to grow and can double by 2050. And there's a couple ways that you can reduce emissions, such as through efficiency improvements, carbon offsets, carbon capture, but also new propulsion techniques. However, there's limited amount of emissions that can be reduced from these new technologies. And SAF is the only solution in the near and medium term to really reduce emissions and enable for us to meet the 2050 net zero targets that has been pledged by the aviation industry. And the reason for this is that SAF is a drop-in fuel, meaning that it doesn't require any infrastructural changes. It meets all current performance and safety requirements. It's commercially proven, and there's also various production pathways and you can get SAF. And through the use of SAF, you can get up to or even more than 85% carbon reduction. Of course, this depends on feedstock and the pathway, but you get some substantial emission reduction through the use of SAF. So at SkyNRG, we entered the SAF industry or the SAF business in 2009. We're one of the market makers where when we first entered the business, the SAF market was really at its nascent stage. This enabled for us to really help develop the SAF market through the years. We were the first one to supply SAF to the first commercial SAF flight and also obtain an RSB certification for SAF as well. And at first, we started more as a SAF supply and trader, but we see the importance also of owning our own SAF and producing SAF. So now we are developing SAF production projects globally. We have upcoming facilities under development in Europe, but also the US as well. And most recently in 2023, Macquarie Asset Management invested in SkyNRG to really help us grow even more in the SAF industry. So just a brief overview on what we do as SkyNRG. We develop SAF capacities and partner in sourcing of SAF, but we also still supply SAF to aircraft operators and also sell SAF to provide SAF solutions for corporates and individual travelers as well. And because of our experience in the SAF industry, we provide advisory services on SAF throughout the whole supply chain of SAF. And most important of all, really, sustainability is really at the core of what we do. We work with a separate sustainability board that helps advise us on different decisions we make at a company level to really ensure that everything that we do is as sustainable as possible. Next, I want to touch briefly on how SAF can be purchased. So SAF can be purchased using the book and claim system. And using this system, you decouple the physical fuel from the green attributes of the fuel. This means that when SAF is produced, the green attributes can be allocated to Scope 1 and Scope 3. And Scope 1 would be emissions attributed to direct emissions such as from airlines. And for Scope 3 emissions, these will be emissions attributed more to indirect emissions such as from corporate business travels or air freight users. So at SkyNRG, we have our own book and claim system, and we work with SABA and RSB to ensure that these green attributes are correctly allocated to all our customers. And using this book and claim system, there's a couple advantages. First, it makes SAF consumption location independent. This makes it easier for SAF distribution, but also enables a more sustainable SAF supply chain as well. And using the book and claim system also reduces the overall costs. And this can be done, for example, through cost sharing of SAF from Scope 1 users and Scope 3 users. And because of this really stresses the importance of all the parties in the SAF supply chain, not only just the SAF producer, but also the Scope 1 users and the Scope 3 users, and their importance in enabling the scale-up of SAF. So we really need everybody, not just airlines and SAF producers, but also business corporates as well, to use SAF to really enable the scale-up of SAF as well. Yeah, so I think now we can jump into the SAF 2030 market outlook. As I said earlier, the market outlook is divided into two sections. So we'll first start at the 2030 market outlook. And before we begin, we can start with some terminology that's used in the market outlook. Primarily, SAF is produced from three different types of feedstock. First is the fats and oils, in which in this presentation, they're categorized as HEFA and co-processing. The second group of SAF is produced from biomass, and this is done typically through gasification Fischer-Tropsch or the alcohol-to-jet pathways. And lastly, we have the third group called the ESAFs, which is produced from renewable energy and carbon dioxide. So this will be the terminology used throughout in this presentation. Here we have a picture of the world map highlighting where the SAF mandates and targets are. Take note that this is has been updated as of May 2024 when the market outlook was published. Here we also highlighted different regions where a SAF market mandate and target was announced, proposed, or under discussion. So if we looked at this world map a couple years back, it looks quite different from what we see today. And we see really that the mandates and targets are gaining traction beyond the EU and the US, with lots of new regions in the APAC region as well that is stepping up and considering SAF targets and or mandates. So overall, these mandates and targets now add up to approximately 16 million tons of SAF demand by 2030. And this is quite important since these mandates and targets are the key enablers of SAF demand. But it is really important to also note that in different regions, you may have different incentives and regulations that support these mandates and targets. And so the demand certainty coming from different regions may also differ, with the EU, for example, being known to have the most strict regulatory requirements for SAF, for example. The EU right now is the largest mandated SAF hub globally. However, things may change as mandates in other regions materialize, for example, in the APEC region, particularly in South Korea and China. We may be seeing an additional 2.9 million tons of SAF mandates that may be coming up in the future. So how do these SAF mandates and targets compare to the net zero targets that we have? In the EU and the US, these mandates and targets go up to 2050. However, we see that in different regions, there is a lack of volume in the SAF mandates and targets, but also a lack in longevity of these targets and mandates as well. And will be requiring different countries in the APEC region and South America to really step up, increasing the volumes and increasing the longevity of this SAF mandate and targets to really increase the SAF demand, which will help us reach the net zero targets. But as of now, the regulations outside the US and the EU is lacking in volume and longevity to make us aligned with the net zero targets that we have. So far, we have discussed about the SAF demand from the mandates and targets. Next, I'll touch a little bit on the expected SAF supply. So I think we'll start briefly with how we estimate the SAF supply. So what we do is that we check every renewable diesel and SAF announcements and estimate the realistic SAF capacity. So this is divided into 3 separate steps. So when the first step is to identify all the announcements based on public information. Take note that the cutoff date of these announcements is the 1st of April, 2024. And this list totals to amount of approximately 341 facilities. And based on this list, we exclude announcements with a low probability of materializing. This means that all announcements that are in feasibility stage is removed. Announcements with no public updates in 2 or more years are also removed from this list. And facilities characterized with a high degree of compound risk are also removed. After this, we adjust the SAF output when the market intelligence differs from the public information, but also adjusts the output when only the renewable capacity is known. And we estimate the realistic SAF capacity by applying an average SAF yield based on the licensed technology that will be used in that facility. Take note that our SAF capacity estimates are based on the nameplate capacity, and ramping up of the capacities is not included in this analysis. So let's jump in. Globally, we expect to see the production capacity could grow up to around 17 million tons by 2030. And it's really important that all these announcements will have to succeed for us to be on track for the net zero targets. Looking at the different technology types, we see that the majority of the announcements or the upcoming SAF capacities will be HEFA-based SAF, which is around 85% of the total capacity. However, we also see that there are other pathways, such as the alcohol to jet, that is also picking up. And this is happening primarily in the US, where there are supply chains for corn ethanol, which is being leveraged to produce alcohol to jet SAF. In addition to this, there are very limited SAF volumes coming from advanced biomass feedstocks. This includes second-generation feedstocks and also eSAF. And in addition to this, a lot of the facilities or the HEFA facilities have a fallback option where in the case of insufficient feedstocks such as UCO, they can switch to vegetable oils. And this means that around 10 million tons of SAF could be coming from agricultural crops for feedstocks rather than waste oils and fats. Looking into SAF production by region, North America is responsible for 40% of the expected SAF capacity by 2030, and this is the largest. And this is they're responsible for the largest SAF capacity. And one of the reasons for this is that on average, facilities in North America have a larger plant size, and this is due to their existing supply chain for vegetable oil production and corn ethanol production, allowing their facilities to be much larger than facilities that we've seen in Europe. In addition to this, we also see that Asia Pacific is also growing rapidly, quickly increasing in their share of capacity. And this is also primarily happening in China, where traditionally they were exporting a lot of their UCO to different regions, but now we see them stepping up and using their own feedstock for the production of SAF. I think Harry touched on this briefly. What this could mean for us is that there can also be an increase in feedstock pressure for those that are reliant on UCO imports from China. In addition to this, we also, in regions like in Asia, there's also shorter lead times, enabling them to really scale up very rapidly in a short duration of time as to compare to other regions like Europe or North America. Aside from Asia Pacific, we also have Latin America, who similarly to China is also stepping up in production. So regions in South Latin America, they have quite a lot of feedstock for sugarcane ethanol. And what we see is that traditionally there are large exporters of this sugarcane ethanol, but we see them slowly stepping up as well and using this feedstock for the production of SAF. So what can be expected is that by 2030, Latin America may also emerge as another major SAF production hub, taking advantage of the feedstock that they have in their region. And again, this can put quite a lot of feedstock pressures for regions that are dependent on feedstock imports coming from Latin America, particularly sugarcane ethanol. And so here we have a graph. So at SkyNRG, we've been making the market outlook for the past couple of years. In the first couple of years, we've put our focus on the EU and the UK, enabling us to really track changes over the years on how the expected SAF capacities will look like. So here we have a graph comparing the expected SAF capacities in 2022, 2023, and 2024. And what we see is that there is an ongoing trend of delays in this sector. And although this graph is shown for the EU and the UK, it could also be applicable to other regions of the world as well. So currently in the EU, only 30% of the announced capacity is operational or under construction. However, you really get the SAF outputs when steel is really put into the ground. And because of these ongoing delays, there runs a risk of insufficient SAF production, for example. And it's important to note that quite a lot of changes has already been seen since summer last year. I think Harry touched on a couple major delays that have been announced last year. And what we see is that one of the major reasons for these delays include awaiting policy and demand certainty. We see financing challenges, but also technical challenges as well. For example, in the EU and the UK, for example, the mandate implementation could be one of the reasons we see the delays. In the EU, we implement a step change in the mandates, meaning that in 2025 all the way to 2029, there's quite a low volume of SAF demand, and there is a rapid jump in 2030 where the mandate increases. This can mean that any facility that starts producing in 2027 all the way to 2029 can be above the mandate, surplus above the mandate, which discourages producers from materializing their facility unless the mandate is higher. And what this means is that if the EU implements a higher blending targets, for example, there can be a larger market confidence, really pushing more facilities to materialize between the time of 2025 to 2029 before a jump in the 2030 mandate. Again, here is an overview really of all the mandates and targets, which add up to 16 million tons. So here I'll overlay with the expected SAF capacity to really demonstrate the expected deficits and surpluses around the world. So it's important to note that in this figure here, we're only focusing on regulatory demand. This means that in regions with targets, this is not considered a regulatory demand. And based on this, what we see is that there is lots of regions in surpluses, but also some regions with a SAF deficit. And these surpluses can either be used to export it to other regions to fulfill their regulatory markets, or can also flow into regulatory markets as well. And what we expect is that the surpluses from the APEC region, typically the facilities being constructed there, are producing EU eligible SAF. So we expect to see some of that volume flowing into the EU, along with some minor volumes from North America and Latin America flowing to the EU as well. However, the majority of the facilities in North America and Latin America are not EU eligible. So we also see part of that volume flowing to regions like Japan as well, which has a less stringent sustainability requirement compared to the EU and UK region. So these are the expected SAF flows. And I think to conclude the 2030 SAF market outlook, I'd like to stress really that the global regulatory developments is very important in the SAF market and the feedstock availability. With the upcoming mandates under discussion from China and how they're moving from being a feedstock exporter to a feedstock user and a SAF producer, this can really put a lot of feedstock pressure in regions like the EU and the US that have been dependent on feedstock and SAF exports from these regions, as we see SAF production in China, Singapore, and South Korea really staying domestically to fulfill their own regulatory markets. We may also see more protectionist policies as well in the US and the EU that help really protect that domestic market. Harry mentioned this already earlier, but there may be upcoming tariffs, for example, or could be policies similar to what we've seen with biodiesel and renewable diesel as well in Europe and the US. In addition to this, another factor that can impact SAF and feedstock availability is really the ramping up of the regulatory ambition in the maritime and the road transport as well. A lot of the facilities right now are HEFA-based facilities, which can either be optimized for renewable production or SAF. And changes in these regulatory ambitions can also cause refineries to optimize for renewable diesel production instead of SAF, and really impacting the availability of SAF in the market. Moving on, I think we can jump straight to the 2050 market outlook. So the 2050 market outlook is based on modeling work, assuming that the technology deployment of different pathways is similar to the technology deployment we saw for corn ethanol in the US. When corn ethanol and the technology for corn ethanol in the US were deployed, there was quite a lot of incentives backing up and scaling up of corn ethanol. So we expected to see a similar technology deployment rate for SAF as well. In addition to the technology deployment rate, we put a restriction on feedstock availability in the model as well. And this feedstock availability is based on the assumption of how much aviation can claim in these feedstocks for SAF production. So for example, for waste oils and fats in 2050, it was assumed that aviation can claim 60% of the total waste oils and fats globally. And you might have noticed already that in 2050, there's quite a large jump in availability of waste oils and fats compared to 2040. And the reason for this is that we assume that there will be more waste oils and fats coming from perennial and cover crops that will help increase the availability of these feedstocks. In terms of biomass, it is assumed that aviation can claim 20% of the total global biomass in 2050. And as for green hydrogen, it is also assumed that aviation can claim 20% of the total global green hydrogen availability as well. And based on these assumptions, we can estimate the approximate amount of SAF that can be produced coming from these different pathways. And what we see is expected SAF capacity in 2050 based on the feedstock assumptions that we have made. As I mentioned in the previous slides, that for the waste oils and fats, or the HEFA pathway, it was assumed that new bio-oil supply chains will be developed. But even then, there is quite a large constraint in the growth of the HEFA-based pathways based on the feedstock availability. And by 2035, you see that this remains quite stagnant, meaning that after 2035, a rapid scale-up of other pathways, such as the bio-based pathways or the eSAFs, will be needed to really scale up SAF. However, both these pathways, the bio and the eSAF, will not be materialized, or at least at a significant volume, unless there are incentives and mandates really supporting their growth. Yeah, in addition to this, of course, there's quite a lot of uncertainties in the 2050 market outlook, and this is largely dependent as well on how the aviation industry evolves. The expected aviation SAF demand is based on IATA estimates, and they've estimated quite an aggressive growth in the aviation industry. And of course, there is a large uncertainty of how the SAF prices will impact the 2050 aviation demand. So there is quite a lot of uncertainties how the overall SAF demand will look like in 2050. Nevertheless, it is still important to stress that to meet the net zero demands in 2050, new production pathways will have to scale out. And as we saw in the 2030 market outlook, the main production pathways is primarily the HEFA-based pathways, but there is a large limitation of these pathways being the feedstock. And so new pathways will really need to be developed. And this will need investments, innovation, and really collaboration from every party in the entire supply chain to really scale up these pathways. And it's something we have to do today to ensure that by 2035, these pathways are ready to rapidly scale up. So that's all that I have prepared today. I think if you have any questions on the market outlook, it is a report that we publish every year, and this report can be downloaded on our website. And of course, if you have any questions on what we do as SkyNRG, the market outlook, or purchasing of SAF, for example, feel free to reach out to me. I've added my colleague in here as well, Jez. He works with the sales of SAF, so feel free to contact him as well. But yeah, I'd love to take any questions now as well.
Excellent, Daisy. Again, very interesting. I think we all know that we're just at the beginning of this journey. A lot of challenging ahead of us, but that's exciting, and that's why we are all working together. Happy also to see that HJ and ASAP are promising, and we at ASAFA, as you know, we are also trying to push those pathways in the region, because Asia is very HEFA centric at the moment. But okay, let's focus on, I think you have one question mainly. It was about the technology, new technologies for the SAF plants in EU and US. Which technology will we use? And give us a bit of more visibility on the financing. Please.
Yeah, if you don't mind, I'm going to stop sharing so I can view the questions.
Go for it.
Let me see. Here, what about advanced crop cultivation? Do you see potential for supply increase? So to answer that question, yes, I think it depends a little bit also on policy of what is allowed and what is not allowed, especially in the EU. I think that puts quite a large impact on the total biomass availability that can be used. And while advanced crop cultivation can play a large part, I think it's hard to say the extent of the role, since it is something that is not being used commercially today. So it'll also be dependent on the technology developments that enable them to be used at a large scale. Such a big increase. I'm assuming that this big increase from 2040 to 2050 is for the perennial crops for waste oils and fats. The question is this feasible, and how much land area is required for this? That is something we haven't really touched. But of course, again, this depends on new advanced cultivation techniques and the yields of the plants, and also how efficient farming can become. I think it's quite a large question. I don't think there's an answer for that, and it's more something in development. But what we do see is that a larger push for the growth, especially in the EU, for the use of newer feedstocks is needed. Quite a lot of focus has been put on the production of biosafs, but not a lot of focus has been on how to get that feedstock produced. So it's quite a big question. Not entirely sure how much land will be required for this, but it is something that still has to be figured out. I think there is no clear answer for that. The next question is, which technology your prospective SAF plants in the EU and US will use? Can you elaborate a bit more about project financing? Yeah, I think I'll start with the US. Currently in the US, we see the majority being HEFA-based plants and alcohol to jet. I think in the upcoming years, that is probably what we expect to see. There is no incentives for facilities in the US to produce SAF eligible, for example, advanced bio-based SAFs, since these projects are more risky and there is no actual demand domestically from this. As for the EU, although there could be a demand for advanced biosafs, the targets, there is no sub-target for advanced biosafs in the EU, meaning that the SAF targets can be met using only HEFA-based SAFs. There is only a sub-target for eSAFs. So what we see in the EU is that there is only a strong focus on the production of HEFA-based SAFs and eSAFs. There is still a lack of advanced bio-based SAF projects, but it's something that we have to really work on in order to make sure that we can produce enough SAFs after 2035 into 2040, because advanced biosafs will be needed to meet those targets. And of course, there has been quite a lot of facilities trying to produce advanced biosafs in the EU, but there has been quite some closures, both also in the US and the EU, which makes it difficult, for new investors to really invest in advanced biosafs. An example is Fulcrum in the US, which recently closed down, producing SAF from waste. Another facility is Clariant, producing second-generation ethanol in Europe, which is also closed down as well. And this just provides negative signals for investors in the production of SAF coming from these pathways.
All right, Daisy, I'm sorry, we have other questions, but we are running out of time. So what I propose to the people who sent the question, they can share them with us, and then we will be able to dispatch them and come back to them on the case by case, right? Okay. So thanks a lot. I mean, again, very interesting. Lot to do, so which is exciting.
Yeah.
Thank you for everybody. And I think again, if you would like to know more about SkyNRG, you can come to us, or you can come directly to Daisy or Jess, who is online as well. Thank you.
Perfect. Thank you.
Excellent. All right. So we will finish in 11 minutes or 10 minutes. So we're running a bit out of time. We had a few slides also from our side to share with you. So Gabriel and I, we're gonna jump each of us on the slides and focus a bit on the charting a sustainable path for Asia, trying to focus a bit more on Asia from what we have done, right? All right, so I think we know basically all of this. I think what is interesting is that don't forget that Asia is driving the growth in air traffic as well. This is the most dynamic area in terms of growth for aviation in the coming years. And therefore, we need also, if we want to achieve the targets that we will impose in the region, we need also to increase drastically the SAF capacity by 2028 and then 2030. Okay, so in today's discussion, we're going to skip some of them. We will keep some of the points for our next webinars in about a month or so. But we want still to go through a few sites. Gabriel, of course, you jump on me anytime you need. Okay, why SAF in Asia? I guess everybody in the audience is convinced about it. But I'll skip this one. Asia growth, I mentioned that 4 to 5% between 2022 and 2030 are expecting in Asia. Therefore, a lot of things to do. What is interesting as well, there's a lot of major hubs in the region that are undergoing significant infrastructure upgrades. So this is the right time to take into account SAF and how we can improve the delivery of SAF into the planes. And last but not least, CO2 emission linked to the CO2 sectors are going to increase drastically in Asia. So let's tackle that and see how SAF can contribute as a direct CO2 reduction for our aviation sector. Regional policy landscape. Sorry, I'm going quite fast. And again, happy to take any questions now or later stage. You have our contacts, I'm sure, or they're on the website. So in terms of policy landscape, Japan is leading the pack in the region with 10% SAF by 2030. We can have South Korea also as well. We announced in 2024 a 1% SAF blend mandate from 2027. Not giving that much visibility beyond that. And of course, that's one of the ASAFA mission is to work with governments with the support of industry leaders is to define not only mandates by 25, 27 or 2030, but through 2040 up to 2050 or 2060. So we get that long-term investment visibility, which will allow, of course, everybody in the ecosystem to remove the risk and be certain of having enough SAF available at a cost competitive as well. And one thing interesting with South Korea is that, of course, it's a big jet fuel exporter today, one of the biggest in the region. And therefore, we expect all of their companies looking very carefully into SAF. They have announced co-processing pathways today. But of course, we expect them to move into other solutions. The next one is Singapore. Singapore, of course, we all heard about the announcement of just before the Singapore Air Show in February. So we got 1% SAF target by 2026, raising 3 to 5% by 2030. And the interesting thing, of course, I'm sure some of you have heard about it, is the passenger levy. So they will put a passenger levy linked to the distance that you will travel from Singapore outside of Singapore. The fourth target on our regional policy landscape is ASEAN. So we see a lot of dynamic there. A lot of countries are looking into this. Indonesia announced also some things for some targeted policies at the Bali Air Show. Thailand is looking into it, Malaysia, Philippines as well. But today it's still fragmented. And there is not a unified approach yet. And we see also no completely firm options or percentage targets of SAF adoptions in the region yet. So a lot of things to do, but we definitely, talking with the governments in the region, we definitely see that there is a strong interest both from the business side, but also from the sustainability side. China, maybe Gabriel, you want to say a few words about that?
Yeah, China, I think we try to bring to attention the context. China has their own rhythm, let's say. There's certainly ambition to, let's say, move into all kinds of e-fuels, biofuels. We see it already. One of the speakers mentioned, marine is seeking to decarbonize as well. The active side is that China is pursuing, let's say, production of, let's say, e-methanol, for example. I think we see also the same pattern in the aviation space. They definitely are, let's say, one of the biggest sources of feedstocks in terms of used cooking oil, waste oils. Arguably, in the future, even in more advanced pathways, they will play a much bigger role. I think what we can see last year was not a coincidence. There are many SAF producers or SAF projects being announced, all with HEFA technology. If you do add up the numbers, we're looking at, again, with Sinopec, PetroChina, and private companies coming on board, more than 2 million tons of HEFA being produced in the next few years. And we also saw, obviously, hear a lot about COMAC as a engine, well, let's say not engine maker, but aircraft maker. A, B, and C. C is coming along very nicely. We've seen 919. But I think we need to look at the long-term horizon. Undoubtedly, China is going to play a much bigger role in aviation altogether. And we, again, understand that, well, formulation of 5-year plans are being made for the next 15 5-year plan, 2026 onwards, probably really purely commonsensical, but we would say some kind of formal policy would be put into place henceforth, which make a lot of sense to really encourage industry to invest further into SAF ecosystem. I think moving on a bit to the next slide as well, with India, just to cover Asia as a whole. I think it's quite key for those watching the Indian market. They've made very, let's say, big leaps and bounds in ethanol. They've put in, let's say, lots of new capacity, up to E15 for land transport, for example, by end of last year. But really, I think they're looking ahead, right? How they can get on board with SAF as well. Probably, again, 1% might be reasonable to expect for 2027 onwards. There's no, formal targets set, but we should expect something. I would be not surprised if they announce it sooner or later with the current administration. In terms on the ground, actually, UCO is very exciting in terms of India. It's big, obviously, big market out there, but to collect UCO, it's not frictionless, as we noted here. We maybe expect even they utilize some of that bioethanol capacity, make ATJ SAF plants happen sooner than later. But India, again, is something to watch as a market, could play a very big role in this whole ecosystem. Maybe over back to you, Fabrice.
Thank you, Gabriel. All right, so we wanted to share with you a bit what we are doing as well as an association. Our role initiative in promoting SAF in Asia, obviously. So not later than this morning, Gabriel, Willing, and I, we were attending the IHI and A-Star SAF production test wing opening ceremony. Very interesting. The first e-SAF project in Asia. And with that pilot plant, so still 5 kilograms per day, but with ambitious target to ramp up the production. And again, moving into ESAF, which is excellent news, as we are agnostic in terms of technologies, and we recognize that ESAF is also part of the future of SAF in Asia. We will also attend some events, some significant events in January and February. Gabriel will be speaking at ISS Plus and SAF conference next week in Tokyo. So for Japanese friends who are online, please feel free to reach him, and we'll be happy to meet with you in Tokyo. A little bit later in February 10 to 12, I will be attending the Sustainable Aviation Future Congress Middle East and North Africa event in Abu Dhabi as well. So again, happy to engage and to discuss further with you during that event face to face, so that we can learn more and exchange more. In terms of members and partners across the SAF ecosystem, you know that our target is to gather the whole ecosystem, including public and private organizations. So you will read faster than I will speak, or if I try to challenge that, then you won't understand anything I'm going to say. But basically, that is the life of our members and partners joining this as part of the association. And today we have reached a certain number of them. So some of them you know already: Coronair 1.5, A-Star, DHL were there before. But in December and now beginning of January, we have also registered the Airbus, Total Energy, SAF One, who joined our rank and are supporting us in the region and also outside of the region with the expertise and the knowledge. And I think we have also followed us, because next month we're going to announce additional members as well. Our targets, some of you might be familiar with that. We are pushing some targets for 2030. We should also push some targets for 2040 and 2050, obviously, as we said. But let's start with 2030. Ambitious targets, some of them in terms of production capacity, some of them in terms of usage of SAF for the region. Of course, all advance on all technological pathways and feedstock, have a clearinghouse in the region as well in terms of certification. And last but not least, harmonize international, regional, and national system for emission tracking and SAF usage, talking about book and claim, about carbon credits, about CDR, allowing us, in fact, to reduce the price of SAF for everybody in the region, especially airlines who are the last one to pay. Gabriel, maybe a few words on the activities, if you're fine with this. And I think.
Yeah, in the interest of time, we probably go to the next slide as well. Just want to announce the calendar.
Oh, yeah.
Yeah, that will be key. A lot of it is on our website, as much as we populate as much. But the most interesting bits for those on the webinar as well will be also having in-person workshops across ASEAN. Details are to be finalized, but we would have 3 workshops starting April, June, and August in 3 major listed countries, where we really want to address really advanced topics in SAF, really bring policymakers, and really, keep this as a regular event that's small enough, intimate enough to really have some, decision making and some, important topics to be, tackled all at once. At the bottom slide, part of the slide, you can see also working groups. There's something that ASAFA wants to be focusing on quite a bit. We really bring in, again, our members and other experts coming together in small working groups, 10, 15 people with the right knowledge to produce, say, technical, commercial white papers that we can then, again, let's say, help the decision makers in governments, in ministries to really formulate better policy. I think that's what we severely lack in Asia. We really want to start off with 2 working groups. One's on market structures and one is on communications. I think this is where we see most urgently the market needs some kind of, let's say, consensus on these 2 big topics. Last but not least, we do want to announce that Asian Outlook paper from ASAFA will be probably published later this year, but we're starting to work on it with, again, what we hear, what we see from the ground is very valuable from us, but I think this will be an annual kind of, let's say, guidebook or handbook of sorts that we can really piece together what we need for Asia as an industry. as a region as well. I think in interest of time, we probably want to fast track to the last slide already, Fabrice. I know a lot are maybe running, we keep this for February. Yeah, we go to the survey maybe and thank the audience a bit. As you can see, we have a lot of slides, but yeah, in the interest of time.
Next time, February. February, you'll have to connect on February. All right. So yeah, thanks again for your time. We know we are a bit late, so please don't hesitate to take the QR code here. Please fill the survey. That's going to be helpful for us in order to improve the next sessions. If you have questions and we saw that there's some questions that we haven't answered, please come back to us via the website, by our email addresses, and we'll be happy to engage discussions and to answer any additional comments or questions you might have. I think that's it for us. Thank you very much again.